After the 2008 crash, restrictions were put on banks to force them to stop making risky mortgages. That's when they started making risky commercial loans, and now that stores around the country are on the verge of bankruptcy, banks are facing some problems. What's up everybody, I am Jaspreet Singh and welcome to the Minority Mindset. This 2020 great lockdown taught us a few things. You should always keep an extra roll of toilet paper on you. You're supposed to sing happy birthday 2 times when you wash your hands. And shopping malls are so 2019. Okay boomer. This pandemic really solidified the fact that the internet is the future. Online shopping companies like Amazon exploded with more demand than they could ever believe. Online shipping companies like Instacart grew faster than they've ever seen before, and we learned that people will go on social media and spend time on it even if there's nothing new in their feed. Oh, I've already liked your post 4 times. But this pandemic could be the dagger that kills shopping malls as we know them, because big stores like JCPenney, David's Bridal, Neiman Marcus, GNC, and Rite Aid don't know how much longer they'll be able to stay in business. Not to mention the fact that we could be seeing a credit crisis because banks got a little greedy with these commercial loans, and you'll see exactly what I mean in just a minute. This retail shift is what I'm going to be talking about today, so make sure you watch this video until the end because you want to know how you can capitalize on this shift that's happening. But before we get into that, hit that thumbs up button below, because if you don't, then YouTube doesn't share our video with anybody else. Subscribe to the Minority Mindset YouTube channel, that way you don't miss our new financial education videos every single week. And hit that little notification bell too, because if you don't, then YouTube doesn't let you know when our new videos are released. It's no surprise that the world is moving digital. I mean, it's been happening in front of our eyes for over a decade now. I started calling this change the digital revolution because it's really creating a revolution, especially for the people that are capitalizing on this by thinking different. It became really apparent back in 2008 when Circuit City shut down. Then it became even more apparent in 2010 when Blockbuster went out of business. And then it became even more apparent in 2011 when Borders sold their last books. Jeff Bezos made a big bet in 1994 that people would rather shop from their homes on their computer than go into the store and shop, and he won. He was right. That's why Amazon is what it is today. People don't want to go to the mall to shop. They want to do it on their phone or their laptop. And now this great lockdown put the digital revolution on hyperspeed because people are forced to shop online. Like even for me, I started buying groceries for the first time online during this great lockdown. And now, well, this great lockdown could be putting traditional brick and mortar stores that were struggling like JCPenney over the edge. This might be the final push. You have to remember that during this lockdown, the government is handing out a ton of free money to businesses and people to help them stay afloat during this crisis. But when these lockdowns end and all this free money dries up, there's a good chance that people will still be scared to go out and shop and spend money like normal. People are scared about a potential recession, and they're scared about potentially losing their job, and they're scared about potentially getting sick on top of all that. And when people are scared, they don't spend money. That's why already you have about 10 major retailers that are considering bankruptcy because they don't know how much longer they can sustain these losses. But what does this mean for you? Well, there are 3 things I need you to know. First, the face of shopping will change. We already know that shopping is coming online. Like, that's the obvious part. But I don't think malls are just going to disappear. I think malls are going to transform. People won't go to malls just to go roam around and shop like they did in the past, but they will want to go to malls for an experience. So malls will have to deliver on this experience, and one thing that you might see is more stores follow the Canada Goose model, where they have physical stores not to sell their products, but for people to come in and try their products, so stores will turn into more of showrooms. You'll probably see more things like the Capital One Cafe, where people can come in, hang out, drink coffee, and chill, and if you get bored, you can just go upstairs and open up a credit card. And if you do need to spend money, you'll probably see more stores like the Amazon Go stores, where you can just walk in, pick up what you want, and walk out without having to talk to a cashier or stand in a checkout line, because everything is connected to your phone. Second, for you investors out there, the commercial real estate market is probably going to get hurt. Carl Icahn, the billionaire investor, says that his biggest position right now is shorting the commercial real estate market because he thinks it's going to crumble, and he has billions of dollars on the line. Normally when you make an investment, you make money when this investment goes up. So if I buy a share of McDonald's and I hold on to it and it doubles in price and I sell it, well, I just doubled my money. Shorting is the opposite. Shorting is when you make money when an investment comes down. Carl Icahn believes that we're going to see a repeat of the 2008 real estate collapse, but this time in the commercial real estate market. The reason he believes this is because back in 2012, banks started to make some risky loans to shopping malls and retail buildings. And surprise, surprise, banks got a little bit greedy with the loans they were making. As a little bit of backstory so you understand exactly what's going on, before the 2008 crash, banks were making a lot of risky loans to people who couldn't afford them. That way they could buy a big home because they thought their homes could never come down in value. And then to make this problem 10 times worse, banks then started leveraging these loans by taking these loans and packaging them up into something called a CDO, or a collateralized debt obligation, and then they sold these crappy loans as investments to other wealthy institutions and banks. So then when the economy collapsed and people couldn't make their loan payments, banks lost twice. They lost first on the loan side because the loans that they made went into default and foreclosure, so banks lost that. And second, they lost on the investment side because banks had invested hundreds of billions of dollars on these investments which were comprised of these loans. And that created the formula for a crumbling house of cards. Well, after the 2008 crash, when banks were forced to stop these practices in the residential real estate market, they turned to the commercial real estate market. Banks sold loans to commercial real estate buildings and shopping malls, and then they got just a little bit greedy. Banks wanted to leverage up how much money they were making from these loans, so they started packaging up these commercial loans into an index called the CMBX, and then they sold this index to other wealthy institutions and banks as an investment. Sound familiar yet? During good times, nobody sees anything wrong with this because banks make a loan and people are making their loan payments, and banks want to leverage up how much money they're making 10 times or 100 times, and so now they take this loan and they turn it into an investment by chopping it up and putting it into different places, and now all these wealthy institutions are making 10 times or 100 times more than what they were making, and everybody's getting rich, so there's no problem. But if the underlying loan fails, and in this case we're talking about the loans made to shopping centers and shopping malls, then all this extra leverage just amplifies the problem. The power of leverage. So when Carl Icahn first made his investment to short these shopping mall loans some time ago, he believed that the internet would push less people to go into malls. And if less people are shopping in malls, then that means the stores inside of the malls would not have enough money to pay their rent to their landlords. And if the shopping malls are not making enough money from rent, then they wouldn't have enough money to make their loan payments. And if these shopping malls don't have enough money to make their loan payments, then this house of cards would come crumbling down. Well, it looks like this pandemic could finally push his beliefs into reality, but again, only time will tell. And now, if you're wondering where you can go and invest in or short these credit default swaps or the CMBX index, let me start by telling you that investing has risks. You are never guaranteed to make money when you invest. You might even lose money, so always do your own due diligence and don't just blindly listen to a random guy on YouTube. Random guy on YouTube. And you should also know that shorting a stock or an investment has more risk than a regular investment, because when you short an investment, you can lose more money than what you invest. Now, if you've seen the movie The Great Short, great movie by the way, you see a couple of guys with briefcases full of millions of dollars walk into banks to create these short positions to short certain investments that the banks made. That's not easy to do unless you have $10 million and some connections, so it helps that Carl Icahn is a billionaire. You could invest in or short shopping mall companies depending on what your beliefs are. Again, I'm not telling you what to do. You should always do your own due diligence. And by the way, if you are a newer investor, I don't recommend you start by just shorting things. You need to learn how investing works first. And then you have the banks. But before you go and start shorting the banks, let me remind you of a couple things. The commercial real estate division and the shopping mall division is just one division of the entire bank. So when you invest in or short a company, you're investing in the entire company, not just one division. And two, what we've seen happen time and time again is that the government doesn't like to see banks fail. Take that for what you want. But again, before you make any rash decisions, please do your own research. If the commercial real estate industry does crash, then you're going to see a ripple effect because one, if malls shut down, then you're going to see the people that work inside the stores and the malls lose their jobs. You're going to see some bankers lose their jobs. You're going to see people working for insurance companies lose their jobs. Then you're going to have a whole wave of people that might not be able to make their rent or mortgage payments. And so it creates a ripple effect. The key is patience. Warren Buffett says that the stock market is a device that transfers money from the impatient to the patient. I think that applies to every asset class. Now, before I get into the third thing that you need to know, if you are looking for an easy way to stay up to date on what's happening in the finance and business world, well, we have a free finance and business newsletter where our team first breaks down the top finance and business news, and then we show you how this news affects your wallet. That way you can be smart with this money, and our team will email you this newsletter for free every morning at 7:30 a.m. Eastern Standard Time, Monday through Friday. So if you want to start getting this newsletter and making smarter decisions with your money, you can subscribe to our newsletter for free by clicking the link up here or by clicking the link in the description below. Third, this digital revolution is an opportunity for entrepreneurs. Look, every crisis comes with opportunity for the minority of people who think different. The world has been moving digital, and this pandemic just sped this shift up even faster. This creates opportunity for anybody who wants to start a business, because nowadays, if you want to start a business, all you need is access to a computer and Wi-Fi. But you can't just blindly follow the noise. Look, there's a lot of crap out there with people selling get-rich-quick systems on how you can build a six-figure business with no work and no effort required in 30 days. But that's not how business works. If you want to build a real business that generates real money, you need to create something that gives people value. I mean, there's a ton of e-commerce stores out there. What makes you different? Disruption is the key to wildly succeeding as an entrepreneur. I mean, in the 1990s and the early 2000s, people were happy shopping in stores. But Amazon thought differently, and they disrupted that whole traditional retail market. So if you see a problem, find a way to fix it, and then find a way to sell this problem on the internet. Thank you for watching. If you enjoyed this video, share it with one friend. That way we can help spread the word. If you want to learn more about what you should be buying during a recession to build wealth during a recession, we already made a video on it, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.